Welcome to the big interview on the February 18th edition of Money Life. Returning to the show today, Jeff Rosenkranz. He's fixed income portfolio manager at Shelton Capital Management, portfolio manager for the Shelton Tactical Credit Fund. That's DebtX, DEBTX. And if you want to learn more about him, the fund, or the firm, go to sheltoncap.com. Jeff Rosenkranz, great to chat with you again.
Always great to be here, Chuck. Thanks.
Let's dig in to fixed income and what's going on with the market because, well, quite honestly, after we got the most recent CPI data, we had a whole bunch of folks who had previously been saying they thought the Fed had maybe stuck the landing, who now don't seem so sure and are wondering what's going to happen. So what's your big, broad take on where we are economically speaking right now?
A lot of uncertainty. We're at a time where, as you point out, inflation, at best is slowly making progress towards 2% goal, or at worst is reaccelerating. And so you can overlay that with all of the changes that are happening in terms of fiscal policy, trade policy, and the like. And so there's a lot of cross currents here, and I think it's going to take a little bit of time to sort all of this out. And in the meantime, rates markets are bouncing all over the place from day to day.
How does that change your tactics? I mean, you are a tactical credit manager. Are you finding that you're making more moves or you're looking in different areas? What is it doing in terms of you have this much uncertainty creating at least potential volatility? And volatility is sometimes just disguised as opportunity.
That's exactly right. We view it that way. It's creating volatility, it's creating price moves, and as a tactical manager, an active manager, it helps us find bonds that are mispriced. Certainly in the short term, interest rate moves are dwarfing credit spread moves. We have to be cognizant of that. We're not taking as much risk on the long end of the yield curve because it seems like it's a little bit harder to predict what the some of the incoming administration's policies are going to do to things like term premium at the long end of the yield curve. And so we're comfortable with some duration, but we're taking it sort of more in the intermediate part of the curve in sort of 5 to 7 to 10 year duration. But it's also a lot of these changes are going to impact individual companies or industries. Just to give an example, if, depending on what the structure of tariffs look like, certainly you could have some industries or companies benefiting while others suffer. And so what that's going to do is create single name volatility in the bonds of certain companies, and we love that. That's our bread and butter, where we can do deep dive fundamental credit research on companies and industries and pick winners and losers.
As I hear you talk about winners and losers, one of the things that has struck me as I talk to folks on a daily basis is that where I see changes in the bond market is different from other people because I see things come up in topics and subjects. And something that hadn't come up in most of my fixed income interviews for a while was high yield or junk bonds, whatever you want to call them. Now it seems to be back in the picture. I'm hearing a lot more about it. I'm hearing you talk about individual company risk. For you right now, is it high grade corporates? Is it junk or is it both? And what is your outlook on the riskier end of the scale?
So it's both. We like investment grade, again, in that sort of intermediate duration. We think all in yields there are pretty attractive. In high yield, we're also comfortable, generally speaking, double B, single B. Below that, in triple C and stressed credit, it's a case by case basis. So spreads are pretty tight by historical standards. It's not the part of the cycle to just sort of be whole hog in triple C. We don't believe, but there still are opportunities even in that segment of the market. It's just a bit more of a case by case basis.
When it comes to where you are looking, the other thing that has been talked about a lot has been private credit. Are you looking in that direction as well as a tactic to be using in this market, or is that play overblown in your opinion?
Uh-huh. It certainly is a topic of much conversation. So we don't at Shelton have a private credit vehicle. So we're not private credit lenders per se, but it certainly impacts the broader market. And where we think about companies, it's another tool for companies if they have debt maturities or if they're looking to optimize their capital structure. The private credit markets is another tool in their tool belt as they, try to optimize their cost of capital. So we're aware of it. It puts downward pressure in some cases on credit spreads and borrowing rates for companies, which can be a good thing. But from a high level, the private and public credit markets are really converging towards one another. Private credit is starting to behave more and more like the broadly syndicated loan market. And so there's been too much money that has flowed into private credit. It's overbought. The underwriting that's getting done there is less than sterling. And so there will be an increase in problem credits and defaults in that private credit space. But that's sort of a natural evolution of that market as it matures.
Yes, but that also suggests that as public and private kind of morph, there is much less reason to say, "Oh, I really wanna gravitate towards the private." The advantages of private go away if they morph, don't they?
Completely agree. You're getting, the pricing's getting squeezed, so you're not getting that extra yield premium to take that liquidity risk, so to speak. And so private loans are less liquid if you get stuck in a problem credit situation, your avenues to exit are fewer. So you should get paid more for that risk. And as it's gotten competed away, you're not really getting paid as much to take that risk.
That's really, really interesting in terms of what it portends for the market and just the general. Yeah, anytime you've got something that people perceive as having an edge, it can only last so long. Once the whole crowd finds out about it, there goes most of the edge.
That agree, and yeah, I think the market tends to underprice liquidity risk, and because in good times you sort of get complacent about it, but in stressful times in the credit cycle, you really, really wish you had that liquidity. And the other point is you can just look at this evolution and see where a lot of the fundraising is coming in private credit. Sure, it started with institutional allocators, but it seems like a lot of the private credit shops have moved on to raising a bunch of money from retail. And as you know, retail is usually the last one in the door, before things start to go sideways. So we urge caution for people unless they really have the sophistication to understand the managers, the underwriting that they're doing, the pricing that they're getting, and at the bottom line, are you getting compensated for those risks, including the lack of liquidity?
And as you look at this market and all of the things that are those wild cards, going back to where we started as we get closer to wrapping this up, what's your worst case scenario? I mean, you sort of talked about things that look good and where you're expecting it to be, but given that there's so much headline risk and so much uncertainty, you've told us what your base case is, but what's the bad case and what's the trigger for it?
The thing that I think we worry about the most is unintended consequences. There's a lot of changes going on, and I think there's a fair amount of optimism out there in general about some of the impacts, maybe less regulation, less antitrust risk, perhaps faster growth, lower deficits. There's a lot of sort of carrots, but we're making potentially some significant changes to trade policy, regulatory policy. What I fear is like a second order effect that nobody's really anticipating, where you're reordering, supply chains or industrial policy or trade flows. And you just could, things happen that nobody saw coming, and you get shocks to the system. It may not bring, the entire economy down, but it can certainly bring down individual companies or industries or things like that, because those voices aren't heard loudly enough in the discussion when some of these massive changes are being contemplated. And this sort of tsunami of change can perhaps overwhelm individual voices that are sort of crying out like, hey, be careful, some of these changes that you're thinking about making, we're warning you, but the warnings aren't heard. And so that I think that's whenever there's sort of this much dramatic change, it just feels like there could be consequences that people aren't necessarily aware of. That's what we worry about.
Last question in limited time. If you had to guess, how many rate cuts is the Fed going to do this year, and when are they going to start?
Is this an over under question, or is this a point estimate?
Yeah, pretty much. That's a good
No,
way. That's a good
I
way to
think,
phrase it. Sure.
look, somewhere between 0 and 1. It's not gonna be 2. Certainly after the most recent CPI report, there's some school of thought that perhaps the next move is actually a hike instead of a cut. We're not there yet, but I wouldn't take that off the table either. It next time I come back on in a few months, we'll better answer that question. But if you put a gun to my head right now, I'd say 0.
Well, we're looking forward to that next conversation as we see how it plays out. And yeah, there are implications to that answer, but we don't have time to explore them. Jeff Rosenkranz, thanks so much for joining me on the show.
My pleasure. Always great to talk with you.
That's Jeff Rosenkranz, fixed income portfolio manager at Shelton Capital Management, portfolio manager for the Shelton Tactical Credit Fund, Debt X. Learn more at sheltoncap.com. Up next,
Danger, danger.
we're heading for trouble. We're going to the baddest biker bar in the investment world. David Traynor is here, and we're headed to the danger zone in a moment.